Because when a surety underwrites a contractor and says we're willing to bond you, that says something because you don't buy surety. You qualify for surety. That's a really important aspect. And another huge difference between insurance and bonding. Okay. Not everyone can be bonded. So it does set you apart. That's really
Interesting.
important.
Hi, Lori.
Hi, how are you?
I'm good. Hi, Lauren.
Hi.
Hi. This is going to be a really fun challenge today of bouncing between Lori and Lauren. So, but I'm really excited. Today we're going to be talking about bonding. Not like bonding with Lori Faye, but we're going to be talking about bonding with Lori Faye. And the premise of this is one of our episodes that's all about helping people to understand the ins and outs of government procurement and contracting. And so what we wanted to talk about today is the difference between having insurance and having bonding and what impacts and implications that has for the contractor, for the business owner in attaining the various contracts. So, Lori, you are our special expert that's coming in to help provide us with the information to share with the audience.
Thank you.
Would you mind giving a little bit of your background?
Sure. I started in the business 30 years ago. 30 years ago as I worked for 3 major surety companies. I started in the file room basically and graduated to an underwriter and then a senior underwriter and before I went on the agency side. And now I'm on the agency side, so I play the middleman in between the contractor and the surety company. But my background is really important because I have a more in-depth underwriting background. So when I work with clients and contractors, we kind of can get into the weeds a little bit more. And when I make a recommendation, I make it based on sound underwriting and not just, letting the underwriters make the decision. We kind of already do the job for them.
Oh, that makes sense. So one of the questions that I get most frequently is regarding this, or that I see most frequently is, what is a bond? What is a surety bond? And do I need that on top of the insurance that I already have? So could you break that down a little bit?
Yeah, absolutely. Well, first of all, I'm going to start with the difference between surety and insurance because that's really important to get the foundation, right? So insurance is a two-party contract. It's between you and the insurance company. So let's use the example of car insurance. You go and get car insurance. You get car insurance with State Farm, Geico, whomever, right? It is between you and Geico or State Farm as the insurer. When you have a loss, and this is what really sets the difference between insurance and surety apart, when you have a loss on your insurance, the insurance pays the loss, but you are not required to pay it back, okay? Your premiums will probably go up, but you're not required to pay it back, right? That's what insurance is for, right? Surety bonds are not insurance. They're an assurance that something happens. It's a guarantee. And it's also a 3-party contract. So it's between you, the surety company, which, by the way, can also be an insurance company. They have large insurance companies have surety arms, like, for example, Liberty, Travelers, and so forth, large insurance companies that have surety divisions, arms. But it's a very different product, right? So it's between you, the surety company, and the owner slash obligee is the other word for that third party. Obligee, very fancy. And that obligee is somebody who is a public entity. It can be federal, state, municipal, and they are the ones who are requiring the bond. Now, it is a guarantee that something is going to take place, right? So when you can get into that in a second, but what truly sets insurance and bonding apart is that if you have a loss, you may very well be required to pay the surety back because you have to sign something called what's called an indemnification agreement. It's a hold harmless. It's an agreement that you are signing with the surety company that says you are going to hold them harmless of any loss. So another very important difference between bonding and insurance is written with a certain percentage of losses consideration, like a risk pool, they call it, right? When you underwrite surety, when a surety bond is underwritten, it's written with a 0% loss expectation. So the way that's done is not only do we look at the job, we look at the condition of the contractor, we look at the totality of the risk, and we assess that there would be 0% risk. So if they had a loss, we would get that loss back from the contractor. We'd get the reimbursement back. The surety company would get the reimbursement back from the contractor. That's why it's written at a 0% loss expectation, right? Now, I'm talking about all these parties, but I didn't tell you where I fall into place. So,
Right before we get there, Lauren, do you have any questions about what she was just describing?
No, that's very clear.
Yeah.
thank you.
Good.
Thank you.
Wonderful.
So I am the middle woman in this particular case, right? Between the contractor and the surety company, right? I act as their agent and I develop all the information. I do sort of a pre-qualification and the underwriting, and then make recommendations to the surety companies for whether it's for a program for the contractor or for a single job, right? So a minute ago when I was talking about my expertise and my background, that there's a lot of information that is required of the contractor. And when I get the file, we accumulate all this information from the contractor, and then we evaluate them and we make our recommendations. So I am the agent, and I am appointed, my particular company, Locksmith Group, is appointed with 14 different surety companies. So we can make a recommendation to 14 different surety companies depending on how that risk falls. Because not all surety companies are the same. Not all surety companies want the same risk. They're all looking for a little bit different things. You're kind of playing matchmaker, like surety matchmaker. And that's my job.
And that could be very helpful, I think, for a contractor who's looking out there because, rather than shopping around and trying to understand the differences, especially if you're early on, how would you even know? You don't have the expertise to really understand or differentiate the benefits or the cons of working with, or I guess lack of optimization of working with different surety agencies.
Oh, absolutely. So that brings up a very good point, because if you don't have the right surety agent, and if you have a surety agent or some insurance agents that play surety agents, if you don't have that right expertise, you may not fall into the right place, the right surety company that's going to serve you and support you. See, surety is more of a relationship. It's not transactional. Sureties like to think of themselves as a partner to a contractor, right? So in order to find the right partner, like in any relationship, there takes a little give and play, right? And the more options you have, the more likely you are to find the right partnership, right? So you want a surety company that you're going to grow with, and that's going to support you, and that knows you, and that's creating the relationship. So if you don't have somebody that really understands your business, really helps to describe your business to the surety, you won't be able to develop that relationship as fully as it could be.
For a contractor, the purpose of getting bonded is an assurance for the company that they're going to be doing work for. It's not really for them because they're going to have to pay back whatever losses or damages that take place that the bond is covering. But it's to make themselves more advantageous, to set themselves apart from other people that may be applying. And I know that I was in communication with a company, I think it's called Sweets Construction out of New York City. And I was trying to get some of my clients involved with them to get some contract work. And he said the number one thing that people fail on is bonding. And then it was after that conversation where I went to Lauren and I was like, we need to talk about this. And then we talked with our director, Erica, and she's like, you need to talk to Lori Faye.
Oh, that's great. That makes me feel good.
So insurance covers losses. Bonding covers losses. So what difference is it covering? Like if something happens on a job, can you give an example of when
point.
Insurance would come in versus when bonding would come in?
Yeah, sure, I can. Do you want me to just take a step back, though, on something that you said? So you were talking about the contractor and what obligés, what the owner is, right? So why a contractor would need a bond.
Right.
which is really important, right? So, and how it does set them apart. It absolutely sets them apart because when a surety underwrites a contractor and says, we're willing to bond you, that says something because you don't buy surety. You qualify for surety. That's a really important aspect. And another huge difference between insurance and bonding, okay? Not everyone can be bonded. So it does set you apart. That's really important. Now, who needs bonding? For the majority of bonds are written to state, municipal, or federal on federal projects. Okay, so those are the owners. The examples can be the town of Farmingdale. Okay, it could also be the U.S. government. It could be the state of New York. It could be the city of New York. The SCA, the School Construction Authority, the MTA, the Metropolitan Transit Authority, is a state agency. This is something that has been governed since 1935 when the Miller Act was passed. Actually, I think it was a little bit sooner than that, but the Miller Act was passed in 1935 requiring bonds on federal projects, okay? So that's really important to say. But
I want to pause real quick. So you're saying that for all federal projects, you must be bonded. It's a pure baseline requirement. You're not even eligible.
So there's yes and no. Okay. There are some exceptions, and there's some dollar amount values. Okay. Some agencies, because it's not just federal, it could be state,
right? It
could be city, it could be town, right? But yes, it is to protect the public's money. Okay. That is why bonds were mandated. So that when you have a public project to build a school, to build a road, to build a post office, whatever it is, you are hiring a contractor that's been pre-qualified and has bonding. Mm-hmm. Okay? That is why it's necessary, to protect the public's money. Now, you mentioned a contractor suite and how they would require bonding. You can also be required to have a bond to a general contractor who wants to protect itself from subcontractor failures, okay? So they, even though they're not a government agency or city, state, or whatnot, they may want to protect themselves from failures. Now, another way a bond could be needed is by a private company, a private developer who has banking money financing the building of a project and wants to, and the bank is requiring the bonding to be required.
Sense. That makes total sense.
Or a condominium. Mm-hmm. Maybe a condominium. You've got a lot of owners and they're putting in a big, huge project in a big skyrise condo in Manhattan. They want to make sure that their money is being protected by a surety bond. So they may require a surety bond. So there could be, a couple of different ways surety bonds are required. Your next part of the question is the difference of losses, right? Oh, I can't believe I remembered that.
I know. I was sitting there rolling back in my head thinking, I was like,
really good.
am I going to remember this? And I actually did, which Sarah and Lauren both know that's a unicorn, I think, for both of us. So this is really awesome.
So the losses. So insurance has losses on property damage and personal injury.
Okay.
That's what insurance protects you against. That's what a general liability policy protects you on for insurance.
Okay.
Property damage and bodily injury. A surety bond does not protect you against any of those things.
Okay. So it doesn't overlap.
Does not overlap. A performance bond and payment bond, they usually come together. There's two kinds of bonds that are usually required together.
Oh man, here we go.
They're all in one. The performance bond says that the contractor is going to perform the job according to the specifications that are outlined to them, right? They can't make up how deep the concrete is or what color the brick is or how high the roof goes. According to the specifications and within the time allowed. That's a really important aspect that a lot of people forget on the performance bond, but that's what it's guaranteeing. They don't want you, a contractor, to have a multi-million-dollar contract to build a school and take 3 years. They say this job has to be done within a year. You've got to be able to perform that job within that time period allowed.
So that's interesting. What if we play this scenario out in the negative form? If a contractor picks up the contract to build a school and it goes over time, right? This is where the bond kicks in. So I'm sure that this can play out in one of a dozen. Right. I'm sure this can play out in a dozen different fashions. But what happens at that point?
Well,
what happens to the contractor? When
we need a
does
whole
the...
other podcast for that, but I'll give you the short answer
Okay,
on that.
thank you.
There's usually liquidated damages, which are damages that they are responsible to pay. It's a penalty, basically, that they have to pay. Also, they'll get defaulted. They'll get defaulted and they'll get kicked off the job at a certain point when they know that the job is getting to the point where it's so delayed that they'll probably get defaulted on the job and possibly another contractor will be brought in to complete it within that time period, right?
Lauren, does this go into debarment, or is that an entirely separate thing?
It's separate. You know, if you don't perform on the government contract that you've been awarded, there are definitely penalties like debarment or possibly blacklisting.
Yeah,
Right.
Vendexed
Yeah.
is another term for that. You know, you can be Vendexed by not performing on contracts.
So
The
is
other,
this-
there is
is
another
this-
part of the bond, though.
Just real quick, just on that point,
Okay, good.
is that an official list? Like, is this, so it's kind of just like almost not interpersonal, but like it's just understood that you perform. Like, how does that information get out to other contractors? Where like that kind of blacklist, that Vendex that you said, how does that information get out? Like, how does that impact?
It depends on the level of government. Federal government has a different way of doing it than state and cities. So it really depends on what level of government
Got it.
you're working with.
Okay, and so
I can also
this
add to
goes
that.
this goes to the point that what you had brought this up earlier when you're talking about kind of doing the pre-qualifications through what you do as the agent between the surety agency and between the contractor, is that you're doing these pre-quals. And so you're checking their financials, you're checking their performance history, you're doing all of these things to make sure that they're actually a good fit. So you're doing that to make sure that they're a good fit for the bond,
Right.
correct?
But let me just add to Lauren
Please.
for a second. Vendex is an official list. And I just had this discussion with somebody the other day about what qualifies you to be Vendexed.
Okay.
Whether it's for sure if you had labor violations, labor payment violations, which is part of I'll get into that in a second. But also, all these government agencies, you have to already be pre-qualified. Not anyone could just throw in a bid to the SCA or the MTA or probably even the U.S. government, because you already have to be pre-qualified. So if you were to have a loss of some sort, you would not be eligible for that pre-qualification to even be on the bid list in the first place, or be able to submit your bid in the first place. It would just be thrown out. But before we get too far, I do want to tell you about the other half of the bond, which is the payment bond.
Yeah, please.
Because those two bonds go together. And
So
that's really
so the two
important.
bonds are, there's a performance bond and there's a
Correct.
payment bond.
Right.
Okay.
And they go together, but they're two very distinct obligations.
Okay.
So the payment bond says that the contractor is going to pay everyone involved. So he's not going to just take off with the money, basically. He's going to pay his subcontractor. He's going to pay his laborers. He's going to pay his materials. And he's going to pay his subcontractors. He's guaranteeing basically the payment of his subcontractors or materials or labor. It actually goes down to that third level of guarantee. So that's a really important part of it as well, because the payment bond part of it is actually the bond that has the majority of losses, because there's usually some sort of payment obligation that hasn't been paid, and that's when a loss would incur. Now, we were still talking about the difference in losses
Right.
between insurance and that. So I'm just going to summarize that a bond, unlike insurance, which is personal liability, personal injury, and property damage, it's the performance of the work according to the specifications within the time allowed, and the payment of subcontractors, materials, and laborers, right? So that's where those losses come. That's why they're very different than insurance.
That is.
Now, there's also a bid bond.
Yes.
Can we talk about that as well? Because there's all these different types, and a lot of times small businesses are confused, when they're reading a bid. What is this bid bond? What's a payment bond? What's a performance bond? And what is my obligation for those?
Yeah, that's a great question. So the bid bond is often, almost always, I say almost because there's always an exception to the rule, right? Required when you are going to bid on a project. This is the first and most important bond because that is where the surety company is guaranteeing that if you are the lowest responsible bidder, you will provide the payment and performance bonds that I just described.
Interesting.
So that's really important because all of the underwriting happens then. Okay. Not when the final bonds are required.
Even for the future bond, the bonds that's essentially assuring are going to take place, the underwriting for all of that happens.
So if you are going, so this is where a lot of confusion comes in because people think of it kind of as non-important, really. They're like, oh, it's just the bid bond. Oh, it's just got a 10% penalty value, which is important for me to note what that penalty value means. So a bid bond will come in a form, it will say, you have to provide a bid bond in the form of 10% of the amount that is going to be bid. So let's say you're bidding $1 million job. So that would be a $10,000 performance bond. Oh, I'm sorry, 100,000.
100,000 zeros.
We do that over
Yeah.
a lot of zeros.
We'll edit that
so
out.
100,000. Want me to start over?
No, it's fine.
So the bid bond has a penalty. So the penalty might be 10%. So if it was $1 million bond, it would be $100,000 penalty when we're using the example of a 10%. Could be 5%, could be 7.5%, but generally it's 5 to 10%, right? So we would write a bond that said this bond is for the penalty value of 10% of the amount bid. So when we underwrite it, we're not underwriting a $100,000 bid bond. We're underwriting the $1 million contract.
Got it.
We are making sure that that contractor is able to perform a $1 million contract. Okay, that's really important because it's not just a $100,000 bond.
Right.
Now, what does the penalty value mean? The penalty value means that if you are the lowest responsible bidder, that's what the bid bond does. It says that you are submitting this in good faith, and that if you are the lowest responsible bidder, you are going to provide the payment and performance bonds. But what if you don't? What if you decide, I don't want to do this job? What if you decide, I have another opportunity down the block that I'd rather take, and I don't want to go into this? Well, that's where the penalty comes in, that 10%.
Interesting.
You would be responsible to pay the 10% difference, the 10% penalty value, or the difference between you and the next bidder, whichever is higher.
Oh, whichever's higher. Ouch.
Right. Now, some forms do say whichever is lower, but they've kind of phased those out. The majority of the forms say the difference between you and the next bidder or the bid bond amount is what the penalty would be for not entering into the contract.
At what phase of this does that kick in? Is it before? I mean, you're saying the next bidder. Do you have to be selected for the contract and then you back out and then that's where that all kicks in? Or can you, if you put in a bid and then you see a more attractive opportunity and you're like, I want to pull out, are you still penalized at that point?
Yeah. So you put in a bid with the bid bond, which is guaranteeing the performance and payment bonds, right? If you are the lowest responsible bidder.
What does that mean?
Okay, so if there are 5 bidders and they're all for $1 million, you bid $1 million, the next guy bids $1.1 million, the next guy bids $1.2 million, the next woman builds $1.4 million. If you are the $1 million bidder, you are the lowest responsible bidder.
Got it.
If you are deemed the lowest responsible bidder. Now, what does responsible bidder mean? It means that you've presented a properly prepared bid with all the required forms, and every agency is different, and that you have a bid bond and so forth. So you didn't make a mistake. If you've made a mistake, then you would have a legitimate cause to request to take your bid away. But other than that, if you are the lowest responsible bidder, you are to be understood to provide the payment and performance bond. At that point, if you decide to back out, that's when you could have a penalty.
Maybe I missed it. At what point in the bidding process?
So if you are the
liable?
lowest responsible bidder and they are going to award you the project and you decide you don't want to enter in it.
So, so when they so you put your bid in, they're going through the review process and they're extending you the offer, and then in response to the offer you say no.
Correct.
That's where the bond kicks in. That's where that 10% penalty, and that's why you have to have that bid bond.
Correct.
to ensure that they're not wasting time because they're already on time.
They're not wasting time. They're not wasting money. They make sure you're pre-qualified, that you've been pre-qualified to perform the contract. There's a lot that goes into it. And it's a very important part of the sale.
I've had like 3 or 4 just brain just huge epiphanies during this that is so helpful for the way that I'm going to be able to communicate with clients about bonding and everything. This is incredibly helpful.
Great.
So thank you. And I feel like we're just getting warmed up too.
So if I'm getting into government contracting and I'm interested in working with the federal government or with other local government entities, what do I need to make sure that I'm bond ready? What industry should I be in? And what do I need to know going into it?
So you've got to be pre-qualified. You've got to know who's your target market and who you're going to work for, and then you have to go and get pre-qualified, right? I mean, that's really important. But for my sake, how to be bond ready is you have to be able to prepare and present a certain amount of information, okay, that we can underwrite. So the most important part of that information is your financials. That is why it is so important. If anybody comes away with one thing here, it is get your financials in order. Get your QuickBooks in order. Get your CPA on it. Tax returns are not good enough. There are programs, small programs, that we can assist smaller contractors with tax returns or credit-based programs, but they have they have limitations. Mm-hmm. But if you're really interested in growing your business and getting bond ready, you got to get your financials in order. So certain levels require, we can use a QuickBooks statements that would be sufficient for up to, $1 million to $2 million, right? Or compilation statement, which is just a gathering or compiling of financial information in a better presentation. But then it goes to review quality financial statement. And there is a specific kind of construction accounting called the percentage of completion, POC basis. So it would be a review quality on a POC basis, which is a form of accrual. I know that's a lot. I know that's a lot of information. I also have a financial worksheet on my website, locksmithgroup.com, that helps people understand these different terminology. But that's what we're for too,
right?
As experts, right? You have to present yourself in a really good way, right? So we ask for a contractor's questionnaire, and I think a lot of people in the business world are like, oh, questionnaire, but you know what? The questionnaire is really important, and the questionnaire is really important because it's all about your company, right? And you should take that seriously and prepare it in a way that really outlines your company. But you should also enhance it. You should also enhance it by providing along with it things such as like a capability statement, which I'm sure the SBDC can help a contractor.
And we're actually going to do a full episode where Lauren's going to break down exactly each component of a capability statement. It's going to be great. So that's what a great preview.
Yeah.
Yeah. So that's great because I definitely want to share that video also with my audience who thinks it's really important, and you will definitely be able to help. But we recommend that they enhance that questionnaire with a capability statement, with resumes, with list of jobs, pictures, brochures, showcase your work. Don't allow yourself just to be a stack of paper on someone's desk. Allow yourself to be presented in a way that is, like a catalog for a cruise ship,
No, I was actually...
that's more...
I was just reading about this strategy that this student that had just graduated college used to make himself stand out with his own resume, and it was called the 8-inch rule. And so what he did was he had applied for, I think it was 37 jobs, and didn't receive a response back from any one of them. And so then he went to like a Staples or wherever, and he got the specialized different kind of paper, and then he asked them to have it cut 1/8 of an inch longer than a standard piece of paper was. And then they're like, oh, well, you're not going to be able to fit this in an envelope. He's like, no, I want you to make me a special envelope that is 1/8 of an inch longer. And so when it literally, if you want to stick out amongst the crowd, like he did, because his envelope was an eighth of an inch longer. And the first person that he sent it to after that responded to him with all of the hate in the world. Like he was so disgusted with the fact that he did it, and he ended up hiring him. He was like, I can't believe you had this stick out. Like, what? Why would you do this? And then they had a conversation. And he's like, all right, we want to bring you on.
Wow.
And so it's just to the point that you do want to have your package, your information, your business stand out amongst the rest. So those are great strategies to add in.
Yeah, it is. And you know, there are the additional information gets a little bit deeper, gets into your personals, because you have to provide personal financial statements and personal tax returns as well. Then banking documents. If you're going to come away with the second thing that's really important is establish a banking relationship, not just a bank, like a relationship, and get a line of credit, because that's really important. Whether you need it or not, to get a line of credit is really important. The surety company wants to know that you have a little something to bounce back from, right? That you have somewhere to go if you need cash and you get in a cash crunch, right? And that line of credit gives them that assurance. Also gives them the assurance that a bank has checked you out too, right?
Exactly.
So that really, really helps a lot. So there's a lot of information, but I'm going to tell you the most important piece of information is good representation. So this is where, it's true. It's true because look, so there are some insurance agents that play surety agents. It's not the same, okay? We have specialized knowledge. We have specialized underwriting abilities. We have the markets that you go to. You want to ask, if you're going to hire a surety bond agent, whether it's me or anyone else, you want to ask them some really important questions. Like,
this is great.
How long have you been doing this, right? What is your experience? What is your underwriting knowledge? How many surety companies are you appointed with? See, if I'm an agent that's only got one or two surety companies, well, I'm only as good as those one or two surety companies are looking for, right? But if you have an agency that has 14, 15 sureties like Locksmith does, right? We're creating an internal competition. I'm getting asked all the time for business because, first of all, they know our reputation. They know how we underwrite. We know how we represent clients. We know that we have the best interest of not only the surety company, but our clients at heart.
So the contractor gets, not only are they presenting themselves, they're making themselves stand out through all of those methods that you were talking about, but they get to kind of glom onto your reputation.
Sure,
because
absolutely.
of your experience and your reputation with the surety agencies.
Yeah,
that's interesting.
We find it, listen, I won't work with just anyone. It's really important for us to have clients that have the same morals and ethics that we do at Locksmith Group, right? But that's why my reputation can stand out, is because we have a certain level. We just won't write every bond. There's many times I have talked clients out of jobs that weren't right for them, and they've gotten frustrated and they've gotten mad with me, and sometimes they've taken them. And they've come back and told me, how right I was, how that was not the right fit, how much they struggled, how it killed their business or killed their cash flow or stopped them from getting another opportunity.
I think you had an experience with a client that went through this.
Yes, like having, if you have to realize there's so many factors that go into getting accepted or awarded a contract.
Sure.
And the worst thing, and I've said this before, is not getting the contract, it's getting the contract and then not being able to perform.
100%.
And there's things you have to think about with funding and staffing, and is it the right fit? Is it the right time for your business? It's just so important.
100% because of that performance time period.
Right.
Is it the right time? It has a lot to do with it. But, cash flow and energy or just experience. I had a situation just recently that, was a contractor who was taking on a job that was completely out of his scope of work and just was like a dangerous risk. And I showed him how the risk is not how he necessarily sees it. And I showed him how kind of we see it by evaluating literally thousands of contractors over the last 30 years. And what I've seen can bring that. And he was like, oh, wow, I didn't think of it like that. And he decided not to take that job. And I was really happy about it. Yeah, and he says, you know what, you care about my company and my success. And you're not just interested in just writing one bond. And I'm like, no, I want to have you for the next 20 years as a client, not just this one bond.
That actually brings up that reminded me, unicorns come back. So that reminded me of the question I wanted to ask. With insurance, you have an insurance policy. If I go back to like the auto insurance, right? For every time that I drive, I don't need to get another insurance policy. Is it every job that I apply for, every bid or contract that I'm bidding on, do I need a brand new bond for every single one?
Yes, that is a great question. So, yes.
Ouch.
But insurance is broad in its coverage. That means it will cover, if it's written properly, assuming it's written properly. By the way, as contractors, you should also get an expert in construction insurance because that in itself is so unique and insurance has so many exclusions that not every insurance policy actually covers you. You would be frightened to see what I see sometimes on insurance policies. But back to the bonds, yes, it is job obligation. It is per job. Okay. It is a sole obligation on that particular project.
Okay. So then that leads me to the next question. From somebody who's getting started in this space, it feels a little bit overwhelming and potentially, and this is where the next question comes in, potentially costly. So when we're thinking about how much it costs to get bonded for a job, can you walk through a kind of scale or how that works?
Yeah, sure. So the good news is it doesn't cost you anything to get pre-qualified. It costs you nothing. At least with my agency, I know there are a few agencies out there that might charge fees. We don't. The standard agency doesn't. You submit your information. We tell you what we think we could get bonded and so forth, and then we go through the process, right? So you start bidding. A bid bond costs nothing. Again, there are some companies that charge fees. Locksmith Group, we never do. We don't charge bid bond fees. So, and sometimes you could bid. God, I had a client that once bid 50 jobs before getting one. So, okay. So there are no fees for that. So that should relieve some of your contractors about being nervous about what this costs because just to get pre-qualified doesn't cost a thing. There are no fees, okay? Then once you bid jobs and you are the lowest responsible bidder and you are now required to present a payment and performance bond, the surety company will put a premium, charge you a premium for that bond. From that premium, I get a commission. Okay. The surety agent gets a commission. It's the same with insurance.
Right.
So if you are an insurance broker and you are submitting insurance through Liberty or Travelers, whatever, you don't charge a fee to your contractor. In fact, if there is a fee, you have to have a legal document. Now, we could add fees. Locksmith Group, we don't. But if anybody has ever charged a fee, there should be a legal document that says there is a fee, and it's the difference between the premium charged and what is being charged. But basically, we do not charge any fees for that pre-qualification.
Wow. Can I ask a question to follow up on that? Is there a difference in pricing for people that are new in business?
Yes. That is another great question. Thank you, Sarah. So yes and no, I should say, because every surety has filed rates with the state that they're in, okay? And they have different scales, and they assess the premium based on the risk. So a newer client to bonding that doesn't have an established relationship already will generally have a higher premium structure.
That makes sense. It's like same thing with insurance. You know, like if you think about like a 16-year-old driver and they're getting 100%. Their first insurance policy and they're like, this is really...
Right. And there's also different levels of risk within that, right? There's, a painter could have a different level, obviously has a different level of risk than an exterior restoration contractor. So, that comes into play as well. There's a lot of different factors that come into play in the premium, but generally speaking, small emerging contractors into the surety world will have a slightly higher fee. Now, I want to just tell you that the fees can be somewhere between 1% to 3% premium that's of the contract value. Now, 1 is a really low rate for especially a small emerging contractor. I would say the standard rate for new small emerging contractors in this space is going to be somewhere between 2% and 3%. Again, That is based on the risk. What does the financials look like? What does their experience look like? What does the job look like? What's the scope of work? How many subcontractors are on? There's so many factors that go into that risk basis, but I just thought I'd let you know. One other thing. There are some programs out there for small and emerging contractors.
Okay.
Like the SBA has an excellent program. I'm a licensed, I shouldn't say licensed. I'm an appointed agent with 4 different markets within the SBA program. Can be a difficult program to navigate, but we've become sort of experts in it. In fact, I think at one point we were number 1 in New York State and number 7 in the country for SBA. That is a wonderful program for small and emerging contractors because it gets them support that they normally wouldn't qualify for because the SBA will back the surety company. They are guaranteeing up to 90% of any potential losses to the surety company. And they have made different, more expansive guidelines of what qualifies for surety bonding. So the surety bonding will have certain guidelines that you have to fit in. Generally, it's about 10% of your net worth and working capital, which might be going into a whole nother topic here, in relation to your bonding, right? So the SBA has expanded that to 20 times, not 10, 20 times. So if you have $1 million in net worth, they would bond $20 million in bonding. But again, there are other factors that come into play. What's the largest job that you've ever completed? Because there's the 3 C's of surety, which maybe we should talk about that next.
Absolutely.
But that program, reason I brought that up when we were talking about premium rates is because there's a fee associated. Right now, because it can change, and it has changed in the past, it's 0.6% in addition to the premium that you would be assessed. That would be paid directly to the SBA. We don't receive any compensation for that whatsoever. You know, there's a tremendous amount of work that goes into it. It's okay because we're helping our contractors grow. And it gets paid directly to the SBA. But it's something that you need to understand when you're doing your pricing for bonds, when you're doing your pricing for the jobs that you're bidding, because those fees can add up. Right. You know, it could be like right there, I could be talking about $36,000 in fees on $1 million job, 3% and 0.6%. So that's something that you have to put into your bid pricing. When you're bidding a job, you have to be sure that you understand what conditions are imposed upon you from your bond agent and from the surety company, so you know what fees are associated.
And that's something that
really important.
That the surety bond agent is going to be able to help guide the contractor through, so that they can add that into their bid pricing.
You don't want any surprises. You don't want to switch and bait, which happens in our industry. I will tell you, it does. You want to be sure that you understand the conditions and any cost associated. And if you have a good agent, it should be very transparent what those conditions are and what those costs are. If it's not, you should ask.
Now, you were talking a lot about construction. Are there any other industries that you have seen that need to be bonded?
So, yeah, there can be different industries that could be bonded. Like you can have a supplier, for example, or a manufacturer supply bond or so forth. We have solar fields, kind of similar to construction. The type of bonds that my expertise is contract surety. So they are pretty much always contractors or somebody relating to contractors, but there are supply bonds as well, guaranteeing a supply of something to someone that might need a bond.
Yeah, no, I have several clients that are looking to get into the supplier space, providing medical supplies from a supplier to hospitals and things like that.
And, so that might require a bond, absolutely.
Right.
Yeah.
Right. No, that makes
and then
sense.
there's a whole bunch of fiduciary bonds and court bonds, but that's not my expertise. My expertise, I can do those and provide those bonds for people, but I generally do it as an accommodation because it's not my expertise and so forth.
I want to give you a scenario of something I see a lot where I have maybe like, let's say, a construction company. They have $100,000 in revenue, and they are looking to grow and get into government contracting. What is their possibility for getting a bond? They're interested in getting bonded. What do you talk to them about? What's the realistic expectation for them going into getting bonded?
What we look at from a small contractor perspective is the first thing is capacity, the first C. So there's capital, capacity, and character. But I'm kind of starting in the middle. As far as I'm concerned, the middle one, right, is capacity, right? We're looking to see what they've already done and what they're able to handle. So if you've got a contractor, you use the example of $100,000 in revenue, that's telling me that, that could be made up of a lot of different ways, $100,000 in revenue, right? It could be made up of a $200,000 job that took 2 years to complete, okay? Or it could be just the timing of such and backlog, right? But what we're looking at is an individual job size and what their largest job is that they completed in order to help them expand that and grow that, right? So if they've done a $100,000 job, it's probably unlikely that they'll qualify for a $1 million job, right?
And that's a very important point.
Right.
You have to be proven.
And I said probably because there are exceptions to every rule, right? For example, you might be a painting contractor. Well, painting $100,000 versus painting $1 million might not be much of a difference. Right. It's just more of the same, right? So that might be something that when we look at the other two facets of the C's, we can work on, okay, to grow, help them grow. But generally speaking, you're looking to double their largest job size. So if they've done $100,000, the next move would be a $100,000 job. They might be looking for $200,000, $250,000. But again, everything's relative. If you're looking at $2.5 million going to $5 million, that's a huge jump.
Right.
Okay. But not undoable depending on there's so many circumstances that go into that, right? But the first thing to look at is what their history is. We look at their resumes. Like maybe they're a company that started small, but the guy or woman, because I have a lot of women contractors, and I love it. It makes me very excited to support other women. But they might have had a history with other companies where they've managed very large projects. We look at that as part of their capacity, right? Their resumes, their resume in full, their jobs in full, who they've worked for matters also, because you don't just, work for Home Depot and then go and work for the New York City Housing Authority. It's a whole different animal. I mean, there's paperwork and requisitions and certified payroll that they might not be familiar with. So they should kind of ease into that. That's the first thing. Capital. The capital is really important. That is why I said getting your finances in order is so important. Start with a good QuickBooks and get a solid base. I always say you can't build anything without a solid foundation, and your finances are your foundation, period. I mean, very important. What a lot of contractors don't understand is they have to finance public work. They have to finance it. They do not get upfront money. They do not get a deposit to start the job. They have to finance it before they put in their first requisition, which might get rejected because they didn't do it right, or somebody has a problem with how much they're crosses out a few things, right? We've got to be able to determine with their finances that they are able to support a project for a certain amount of time before they are able to requisition and the money starts flowing. So we're looking at a certain amount of working capital and net worth of the company, right? The value of the company in order to support that. Some other factors go into capital, such as, what type of contractor are you? Are you a roadway contractor where you have large equipment that is actually making the money on the job versus an electrician who has a lot of heavy labor, which is a lot of out-of-pocket costs. So there's but again, that's where the expertise of a good surety agent can tell the difference between the two and how they should weigh in one of those three C's. And then the last but not least, which is very important because it can count you out, is character. Character has to do with your reputation and your creditworthiness. Do you have bankruptcies? Do you have late payments? Do you have liens and suits against you? That has a lot to do with the character of that company. And they look at that character corporately and personally, because when we are underwriting, we're looking at personal as well. And even in the capital section, if you have personal assets, that could help you get bonding. Okay, because you are personally indemnifying or holding the company harmless as well.
There are a lot of
company harmless.
relations between the underwriting for bonding and the underwriting for getting a business loan. Like there's a lot of similarities.
It's
there.
actually more similar to getting a business loan than it is getting insurance.
That's exactly what it sounds like.
Yeah.
When you go through the list of the things that you're looking at between the financial statements, the credit scores, and everything they have to provide, and even bankruptcies and all of that, that's the exact conversation that we're having.
So surety, though, again, a bank relationship is a two-party contract, right? It's
Right.
between you and the bank. But you still hold the bank harmless. You still have an indemnification. In fact, you have an indemnification when you sign a mortgage, when you sign a credit card, when you sign a student loan. All those things, you are indemnifying or holding that company harmless. Again, the difference is that there's a three-party in the surety relationship. You have to think of surety. When somebody says, I still don't get it, I still don't understand the relationship, I say, pretend that your kid came to you and wanted you to get a credit card and they wanted you to co-sign. That's the relationship. The surety is co-signing your ability to complete your obligation. So that
really helps to simplify it, I think.
Yeah.
That's great. Do we have any of our audience questions that haven't been answered yet? I know that one that you asked earlier, that was from the audience.
Yes. I do have a few. The first one I think is good. So when you obtain a bond, how often do you have to renew it?
Oh, very good question. So you don't renew a bond. Okay. So there are renewable bonds, license and permit bonds or ERISA bonds or some fiduciary bonds that have annual terms. Okay. But a surety bond, which is job specific, is not renewable. It is in effect for the entire duration of the job, no matter how long it takes. So let me give you an example. When you request a bond, usually you have a 1 year to 2 year completion of that project, just as an example, right? The bond doesn't expire after the completion of that project's supposed to be done. It expires when the job is actually done. So there could be delays for whatever reason. During COVID, there were a lot of delays on projects. Sure. They got time extensions. They requested time extensions for whatever issue. Very important to do that if you are a contractor and they are delaying your job for any reason. You need to ask for a formal, because remember, the performance bond guarantees the completion of that job within a certain time limit. So you have to get a formal extension of that project. But the bond doesn't expire. The bond stays in effect throughout that duration of the contract and actually increases in value as the contract increases, believe it or not. So if there are change orders on that project, the bond value kind of covers those as well. Wow. And that's important to know because the contractors need to put in for the bond premium because the surety company, when they audit the job at the end of it, will bill them for those increased contract values. But on the offset of that, if the contract price goes down, maybe they have, some reverse change orders really, you can get money back. Or if the job gets canceled or whatnot, your premium is not lost. Your premium is based on the total contract value at closure. A lot of people ask me how long it takes to get bonding. So that depends on them, really. The truth is how much information they can give me and in what quality, right? So if they give me financials that don't make sense, don't tie in, aren't complete with the proper notes and schedules, or give me an inaccurate personal financial, it's going to delay the process. But let's just say that you give me everything complete and full. It will generally take about a week to 2.
Wow.
Depending on how complicated this case is. Now, how big it is as well. I've been able to turn over a bond in 24 hours on a very small project where I have all the information, easily can turn it over. We have quick applications, which are credit-based. We can go up to $750,000 based on good credit, but you also have to have the capacity to fit that $750,000 because that can be on a single job size or in aggregate, which is a total culmination of how many bonds you have. You could have 200, another 200, another 300. So the aggregate is $750,000, but it can be single depending on what your job experience is, right? That's credit-based only. no paperwork, 2-page application. Great way to start for that contractor you brought up before with the $100,000 in revenue, right? But then you can go up to $1.5 million on those programs with a little bit of information, tax returns and QuickBooks and a good questionnaire and so forth. So those are really good ways to start. I can turn those over in a few hours, really.
That's incredible.
Which is great. But if you're talking about a very big, complicated project with multiple bonding needs and maybe a lot of different affiliates and so forth, it could take a couple weeks. But for the most part, it takes about a week.
If you were speaking to somebody that's inquiring about a surety bond, what are the major limitations or the minor limitations that you would warn somebody about or just want them to be aware of?
Everything is relative to the situation at hand, right? So there could be multiple warnings. I would have to say the biggest one is to make sure that they have the proper working capital. That to me is the most significant risk in any particular bonded project and where everything can go wrong. Because again, a lot of contractors don't realize that they have to finance that project and what that can entail. And if they miss that first requisition, they could go into 60 days. If they mess up on the second application, can go into 90 days. So that would be my biggest risk because they have to understand the indemnification, that they are holding that company harmless on a personal level and a corporate level. And it could affect them, personally, which is why, which is how I've talked people out of it and said, is this risk worth this to you?
Is there a certain percentage of working capital against the total amount of the job that you're looking for to feel comfortable with there?
Yeah. So it's 10%. Okay. Is the baseline kind of. Again, there are so many factors that can come into that, but it's generally 10%. So if you have $10 million of aggregate backlog, that's total amount of backlog. You get a $5 million, $2 million, $2 million, and $1 million job, $10 million worth of work. You need to have about $1 million, right? About 10%. However, this is an important part. The working capital is not based on contract value. It's based on cost to complete. So you can have $20 million worth of work, but only have $10 million of cost to complete. That's the number we're evaluating your working capital on. Really important because a lot of clients will be like, well, I'm like, how come you haven't been bidding? And they're like, well, I have too much work. And I'm like, it's like 90% done. You need another job now. Like, they were like, oh, I thought my program was based on contract value. And I'm like, no, it's not. It's based on cost to complete. So a lot of clients ask me about conditions of bonds, right? What are the conditions of my bonding program? Okay. Now, generally speaking, the conditions of your bonding program is a certain percentage of net worth and working capital to the program size and your capacity, of course, and so forth. And you have to kind of keep that. You can't just grow out of that, so to speak. Like, so for example, if I am evaluating you at $10 million and then you decide to go take another job for $20 million, you're taking those percentages out of balance and you might not get bonding in the future. The indemnification is a part of that condition corporately, personally, and unfortunately, this is something a lot of people don't know. Your spouse has to indemnify as well. Okay? So
this just got real.
I know. And it's
It just
and
changed
this
the
kind of
whole
can scare
scope.
people. And I can get into a whole nother what are the real risk factors. But yes, the indemnification is corporate, personal, and spousal. Okay. Now, there can be, again, exceptions to that rule. Okay. But for the most part, the spouse has to sign. I mean, literally, I have clients with $300 million programs and their spouses sign. Now, some of those could have certain assets, say they have their own assets or their own trust funds or whatever. We can exclude assets, or we could do a non-transfer of assets agreement on the indemnification. I'm getting into the weeds there, which is something that you should discuss with your surety bond agent because everything is individualized, right? But for the most part, your spouse has to indemnify. Now, there could be other conditions. There could be collateral, or there could be funds control, okay? And these are really important to understand. First of all, collateral, to me, I don't have a single client with collateral, okay? Collateral, to me, is nonsensical, okay? What would taking collateral from a client, which is always, by the way, in the form of money, not buildings, not real estate, not car, okay, it's cash. Now, how would that help any of the 3 C's? How would it help their capital? Wouldn't. How would it help their ability to complete the job? It wouldn't. And how would it help their character? It really doesn't, okay? So collateral to me is nonsensical. So unless you have a financial guarantee bond, of course, like I said before, there's always exceptions, okay?
Of course.
But if you had a financial guarantee bond, then collateral might help. But that's not contract surety as we're discussing. The other thing could be funds control. Now, funds control is where the surety company has assigned, whether it's within their surety company or a separate and individual company, to control the money on the project. So the owner obligee, like the school construction authority or the MTA or federal government, would send the requisition money to that funds administrator, and they would distribute the money. This helps eliminate the risk, well, not completely, but helps reduce the risk on the payment bond exposure, which again, I told you, has the highest rate of losses compared to the performance bond, right? That can be a good tool. It also can be a very bad tool, okay? Because it doesn't solve all the problems. So it depends on the individuals as well. Because, for example, if you have an electrical contractor, does funds control really make any sense at all? You have high labor, right? So the contractor has to pay all the labor and then get reimbursed. Like, how does that make sense? Mm-hmm. If you have a lot of subcontractors, though, it could make sense because, in essence, your subcontractors are kind of financing the job too, right? And then you get the requisition and you decide you want to put it on this job or that job or buy yourself a new car, which I've had happen. The funds administrator, especially if you have like a bad credit scenario, okay, if you have not been credit worthy and you've had suits and liens and so forth, that might be a reason that the surety company says, okay, we'll help you get over that character issue and we'll have funds control put in place so that we can make sure that the money is being directed to this particular project. A lot of clients, a lot of surety agents, though, use that as just an excuse or a reason to write bonds when it makes no sense at all. So it has to be appropriate for that particular contractor. Very important, comes with a fee, which is what you have to understand. Like I showed you the premium. Then you have maybe an SBA fee. You have to understand that there's a fee associated. There could also be a fee associated with funds control. The average cost of funds control is about 1%. Okay, so
like you said, these fees stack up.
They can absolutely stack up, and people need to understand their fee structures so that when they are bidding the job, and they don't get the bait and switch at the end. They get a contract from an agent who afterwards says to them, oh, by the way, there's this fee. You know, and it happens. It happens. So you have to understand that fee structure. Bonding is not one and done. You don't apply for bonds, get approved for a bonding program, and that's it. Yeah, you have to present all that information. I'm talking about typical, not the fast bond applications where it's credit-based. And you present all this information. And I have a list of it on my website, by the way. It's Locksmith Group at Let's Get Started. It has all the forms, all the applications. It has a list of all the information you need. But it's not one and done. So you don't get approved for a bond program. You will have to be prepared to consistently update the surety. Okay? A lot of clients don't know that, so they're not prepared. They are going to require 2 financial statements a year. That's an interim financial statement, which is somewhere in the mid-year. You have to talk to your agent what interim date is good for you. The reason I say that is because the general date is 6/30. If your year end is 12/31, but some people have different year end dates, right? But some people will benefit from a 9/30 interim statement because they're a landscaping company and the majority of their business is thrown through the summer, and we want to show a better picture to the surety company. Okay. You have to do 2 financial statements a year. You have to update your taxes, obviously. You have to present a personal financial statement yearly. But then throughout the program, they're often going to ask you to update your work in progress schedules, your banking documents, what usage you have on your bank line of credit, how much cash do you have in the bank, how cash is flowing, and so forth. So it is something that is consistently being updated, and you should be prepared to.
When somebody works with you or another agency, because we have a worldwide audience that tunes in, so are there systems in place, just we'll say specifically for Locksme, that are kind of like reminders that get sent out to them, like, hey, it's been 6 months, like we need this, or is it all on like the contractor to just know?
Thank you for that question, because I love that. Because we are very proactive. And I've worked for a few other agencies and was on the bond underwriting side as well. And there weren't these in place. We are extremely proactive.
That's good.
We send out twice a year a letter reminding you of all the updates that you need, telling you what the last update you had in the file was, and we'll send it out 3 times at the beginning of the year, and so that you respond. And we usually will copy in your CPA if you're okay with that, and we do it at the interim date as well, so that you are very aware of what is going on, because we make sure. And then if we don't get it, I call. When I call, then they know they're in trouble. Okay. So,
Lori's on the line.
they're like, oh, what did I do? So
That's great. What an asset to have, because a lot of times you see middlemen that come up in these different business situations, and people are like, how much extra money am I going to have to spend in order to accomplish something? Like, are they really required? But with the level of detail and complication and everything that comes up with this, it seems like you're offloading a lot of the kind of the meticulous checking and processing and making sure you're going with the right surety agency by going with someone that's already in the field.
Yeah, we try to, our kind of tagline is bonding simplified, because we try to simplify the process, because it's actually not as complicated as people think it is, right? And we try to break it down. Look, I am a business owner, okay? So I understand the expenses that are related to this as well. So we were talking about the requirements going forward, right? And there's 2 financial statements. Those financial statement qualities could differ as well, but that's where you need to have conversation. Communication is very important between you and your bond agent. When I send you, like when we ask for those statements, we say, be sure to talk to us about the quality of that financial statement going forward, because I don't want somebody to give me a review quality, spend thousands of dollars on a review quality financial statement when they don't need it. Maybe they don't need it that year because they have so much backlog, and we can just do a compilation or a QuickBooks update on that mid-year scene, to see how they're doing. And they don't need to have that expense for that. So again, it's constant communication, and which is really important, and keeps them up to date. So you're not scrambling at the last minute, because then somebody comes and is like, I need a bond, and they're like, and I'm like, well, why didn't you tell me I needed all this information? Oh my gosh, we did. We sent you 3 letters.
When all of the benefits and advantages that contractors have from working with you that you just laid out are brilliant lines of questioning that any contractor should take to an agent when they're going to work with them. Like, what are the advantages that you're giving to me? Because I know that I heard on this podcast that there's the Locksme's out there, and they're doing these updates, and they're helping us with this, that, and the other.
Yeah.
Like, what do you do?
Yeah.
And so if they can take this and even export that if they don't happen to be eligible to work with you for location or whatever reason, they can at least take that away and go, like, I know what's possible from an agency, and then I can go do value checks on these other ones.
We actually do have a list of information that you should ask not only your surety agent, but any of one of your circle of professionals. What you should be asking people, because I mentioned earlier that Your CPA, I'm sorry, I actually mentioned earlier that your insurance agent should be a construction specialist, right? But so should your CPA. And not too far away from that is your banker, because a lot of bankers don't understand construction and then won't be able to give you the proper banking line of credit, support you in that as well. So I have a list of information that you should ask any of these circle of professionals, because honestly, all of these people should be centered around your business. They should understand your construction business. They should you should ask them, do you bond or bank or support other contractors like me of my size? Do you understand my business? Because then you're not going to get, then you're going to get, when you have the right people, you're going to get the right output back, right? These are your advisors. These are the people that are going to help you grow.
It's your business
right?
team.
The CPA should be very specific to construction, because construction accounting is very unique, okay? And it's accrual basis, but it's percentage of completion, as I mentioned before, and it's very unique and very different. And so the construction accounting then becomes that much important, more important.
Absolutely. No, that's great. Where people can gain access to that checklist would be through your website?
Yeah.
Okay.
Locksmithgroup.com.
We'll make sure to put it, it should be on the screen, and we'll make sure to have it in the show notes as well, so you guys can check that out.